Take one look at your local dealer right now. Those full rows aren't normal. They're a warning. An avalanche of 2 million motorcycles hit all at once, and the cracks showed instantly. Prices faltered. Sellers panicked. Buyers froze. So what caused this? Did dealerships take shipments they couldn't absorb? And how deep does the price drop go from here? Because by the time you hit the final minute, you'll know exactly how to protect yourself from the next crash wave, the sudden arrival of 2 million motorcycles. No one in the industry expected the surge to hit this fast, and no rider walking past a dealer lot expected to see rows of machines stretching farther than the eye could follow. Yet, in the span of a single quarter, nearly 2 million motorcycles rolled into dealer storage across the country. They appeared without warning, filling every patch of concrete from the Midwest to the Gulf, crowding showrooms that once struggled to keep even a handful of desirable models in stock. Overnight, the rhythm of the marketplace changed. Street-side display rows doubled, then tripled, until the sight of shoulder-to-shoulder metal felt more like a county fair lineup than an American dealership. The shock wasn't just the volume, it was the speed. Riders who stopped by their local shops out of habit found entire backlots transformed into walls of cruisers, tourers, and standards stacked so tightly that sunlight barely passed between the fairings. Even veterans who had spent decades watching boom and bust cycles admitted they had never seen anything close to this. The industry had seen gluts before, but never a tidal wave that washed across the country in a matter of weeks. Across small towns and big cities alike, the reaction was the same: disbelief. People paused at the edges of lots, counting rows, shaking their heads, wondering what ripple beneath the surface had pushed so many motorcycles into the open at once. For the first time in a long time, the shock lived not in a headline or a rumor, but in plain sight. The moment riders looked past neighborhood showrooms, the true scale of the overflow came into focus. The visible overflow. Listings, warehouses, auctions. What riders saw on showroom floors was only the front edge of the wave. The real surge revealed itself online, and in the warehouses where dealers quietly store machines, they have no room to display. Classified feeds that normally saw a steady trickle of listings suddenly multiplied into hundreds of new posts, many appearing within hours of each other. Search pages that once showed a handful of familiar bikes now stretched into screens of identical models, each one photographed from the same angles, under the same fluorescent lights. It felt less like a marketplace and more like an archive. Behind those public listings, the overflow pressed even harder. Storage yards in the central states filled row after row until forklifts moved nonstop, sliding pallets of crated motorcycles from one corner of a property to another just to make space for the next shipment. Yard workers described it as a metal migration, a constant shuffle of inventory with no destination beyond the next temporary spot of open ground. Auction houses felt the impact next. Facilities that typically planned weeks ahead scrambled to prepare overflow lanes, clearing unused sections of their floors just to manage the influx. Staff talked about the wave as if it were weather predictable in pressure, but overwhelming in force. Trailers lined up before dawn, each one carrying machines that had been offloaded from dealer storage only days before. And once the pressure reached the surface, the first cracks began to show. If you want more straight talk breakdowns the industry avoids, take a moment to like this video, subscribe for weekly updates, and share your thoughts below. Your insight helps shape future coverage and keeps real riders ahead of the stories others ignore. The first price fractures. The earliest fractures appeared quietly, almost cautiously, as if dealers hoped no one would notice. A few models that normally held firm at their posted numbers began slipping by a few $100s, then a little more. It was subtle enough that a casual shopper might have missed it, but experienced riders recognized the tremor. When a machine that had held the same value for months suddenly dipped, it was never accidental. Dealership managers adjusted tags with the kind of careful discretion reserved for early trouble. They did not make announcements. They did not hang sale banners. They simply rewrote the numbers and waited to see who reacted. But seasoned eyes caught the shift instantly. The moment one model moved lower, the ripple spread. A second unit followed, then a third. The pattern grew too consistent to ignore. Private sellers felt the hesitation even sooner. A listing that might have drawn several messages in the first day now sat unread. Potential buyers stopped. responding. Conversations faded. People who once planned to upgrade postponed their decisions, sensing something unsettled in the air. Owners who needed to sell adjusted their prices downward, trying to stay ahead of the uncertainty they couldn't yet define. The source of those cracks pointed straight toward factory floors few suspected. Why production never slowed down. Inside the plants, the story looked different from the outside. Assembly lines kept moving not because demand was strong, but because halting them carried a cost many companies refused to absorb. Supplier contracts required minimum orders, and breaking those agreements meant penalties large enough to shake entire quarterly reports. Faced with the choice between building motorcycles with no buyers or paying millions to freeze a production line, many manufacturers chose to keep the machines running. Political considerations added another layer. No executive wanted to announce temporary shutdowns or layoffs during a sensitive election season. Keeping plants active meant preserving local jobs, maintaining positive headlines, and avoiding the scrutiny that always arrives when a major employer slows its output. Even when internal numbers hinted at a slowdown, the optics of shutting down were considered worse than the risks of producing more inventory. Corporate commitments to shareholders sealed the decision. Production targets had already been promised during earnings calls, and missing those numbers would invite difficult questions. So the factories pressed on, turning steel and aluminum into motorcycles with nowhere immediate to go. Workers followed schedules as usual, even as warehouses filled and trucks arrived with fewer clear destinations. Open marketplaces exposed the full force of the unfolding collapse. The hard data crash, the numbers no one can spin. Once the first shock faded and riders started digging into the reports, the truth became impossible to deny. Pricing guides across the industry recorded double-digit drops in a single season, with some regions showing declines that would have been unthinkable even a year earlier. Machines that once held their value with iron grip began slipping at a pace analysts struggled to chart. The numbers did not stutter or hint. They plunged, clean and sharp, the way only hard data can when the market beneath it buckles. Sell-through timelines told a similar story. Where a popular cruiser might have moved in 10 days, the same model now sat for 30 or even 40. In several markets, touring rigs that previously never lasted more than a weekend on the floor lingered for 2 months before a serious buyer stepped forward. Trade-in values shrank just as quickly. Owners walking in with motorcycles they believed still held strong equity left the showroom stunned by valuations that had dropped thousands from what they expected. These figures were not rumors or whispers from back offices. They were printed in black and white, captured in the same data sources riders had trusted for decades. For the first time in years, the market shed its illusions and showed the kind of transparency that only comes from a sudden correction. After the data delivered its verdict, attention shifted toward which segments fell first. Segment by segment collapse. Across the industry, not every motorcycle felt the drop at the same moment. The correction moved through the market the way a cold front rolls across open country, touching each category in its own time and exposing weaknesses riders rarely noticed before. Entry-level machines were the first to stall. These were the lightweight commuters and starter cruisers that once served as affordable gateways for new riders. When the surge hit, they stopped moving almost immediately. With fewer people seeking beginner bikes, dealers found themselves staring at rows of machines that carried slim margins even in healthy years. Midweight cruisers followed next. Weekend riders who once traded every few years suddenly held onto their machines, which left used inventories swollen and new units waiting for an audience that never arrived. Private listings multiplied overnight, filled with descriptions like barely ridden and still under warranty, each competing for attention in a market already crowded with similar offerings. Then came the touring rigs. For years, these models held their value with surprising resilience, shielded by their reputation for comfort and long-distance capability. But even that armor cracked. Riders postponed upgrades, dealerships slowed orders, and the backlog grew until even flagship models slipped from their once reliable pedestal. Beyond segment struggles, dealers faced an even tighter form of pressure, floor plan pressure, the silent dealer bleed. Behind the polished showroom floors and carefully arranged display rows, there is a financial engine most riders never see. Dealers rarely talk about it openly, but it shapes every decision they make. Nearly every motorcycle on the floor is financed through what the industry calls a floor plan, a system that charges daily interest on every unit that has not yet sold. In good years, the system works as intended, giving dealers flexibility. In a flood year, it turns into a slow bleed. Each motorcycle carries its own ticking clock. After 90 days, the interest owed on that unit begins to chew through the margin, sometimes swallowing it entirely. When hundreds of motorcycles suddenly occupy a dealer lot at once, that clock becomes a chorus. Every day costs more than the day before, and no amount of optimism can change the math. Even a modest spike in inventory becomes a financial liability when multiplied across dozens of units. Managers feel the pressure most near the end of each month. Targets loom, interest totals rise, and every unsold machine burns through cash that cannot be replaced until the motorcycle moves. That is why riders notice subtle shifts in tone near final weekends, when a salesperson's eagerness has less to do with enthusiasm and more to do with an accounting line that needs to be corrected before it buries the store in red ink. But while dealers wrestled with interest clocks, the industry faced another force entirely, one written not in ledgers but in regulations. Regulation timers and VIN geography changing prices. Beyond supply numbers and dealer economics lies a quieter influence on motorcycle values, one that has shaped pricing for decades. Regulatory timing. Emission standards operate on predictable cycles, and with every new requirement, older models lose a portion of their resale strength. A motorcycle built only 2 years earlier can suddenly fall behind a new certification threshold, not because of mechanical shortcomings, but because its documentation reflects an outdated standard. Buyers see the change and hesitate, even when the machine itself remains capable. Model year certification adds another layer of complexity. A motorcycle assembled late in one year may carry a different emissions label than an identical machine built a few months later. This subtle difference can tilt the market, especially during moments of oversupply. Riders who understand these cycles use them to negotiate, while others unknowingly absorb the cost of timing they never knew existed. Then there is the geography hidden inside the VIN. Two motorcycles of the same model and year can carry very different import costs depending on where they were assembled. A code indicating domestic production often avoids tariffs that a similar overseas unit cannot escape. Those tariffs, whether 5% or 7%, ripple into the final sticker price, shaping affordability long before the motorcycle touches American soil. With these pressures converging at once, the stage was set for the deeper fractures that would soon shake the entire industry. Auction gravity, where real prices get decided, long before the public feels a market collapse. The auction lanes feel it first. These are the places where motorcycles move without emotion, where prices are set by data, demand, and the cold rhythm of a hammer dropping. When the flood of inventory hit, the wholesale lanes buckled almost instantly. Units that once commanded healthy bids struggled to attract even a handful of raised paddles. A machine that might have cleared a confident number last year now stalled at figures that shocked even seasoned buyers. The collapse began quietly, but with unmistakable force. Alongside these struggling machines came an unusual surge in salvage and repossessed units. Banks, facing late payments, pushed recovered motorcycles through the lanes faster than usual. Insurance companies followed, sending in lightly damaged models that still ran fine but carried the stigma of a salvage tag. These units sold for fractions of their former values, and each sale dragged the overall benchmark downward. Clean title 𝐉𝐨𝐽𝐳 motorcycles sitting nearby could not escape the gravitational pull. The moment a pair of similar machines sold far below historic norms, the lane average shifted. Retail cannot outrun wholesale gravity. Dealers returning from the lanes brought those lower numbers back to their showrooms, adjusting their expectations whether they wanted to or not. A motorcycle cannot retail for $16,000 when its wholesale twin just cleared $8,000. The lanes spoke, and the market listened. Wholesale pressure revealed another weakness. Prestige lost its grip. Badge prestige collapse. When heritage stops protecting value, for decades, the badge on a fuel tank carried weight far beyond its material cost. Harley signaled American endurance. BMW suggested engineering mastery. Ducati spoke to Italian fire, and Honda earned a reputation for bulletproof reliability. These names were more than brands. They were identities that shaped the way riders talked about themselves and the machines they trusted. In normal years, prestige protected resale. It acted like a shield, keeping certain motorcycles insulated from the harsher swings of the market. But when the flood hit, even heritage cracked. Riders shopping for used motorcycles stopped leading with emotion and started leading with calculators. The question shifted from "which badge do you want?" to "how far does your dollar take you?" Listings filled with side-by-side comparisons, not of styling cues or brand history, but of fuel range, maintenance intervals, and long-term durability. A rider who once would have paid extra for the crest of a favored manufacturer began weighing function against cost with a sharper eye. The cultural shift grew louder by the week. Conversations in garages and group rides became less about loyalty and more about practicality. Spreadsheets replaced nostalgia. Riders pulled up charts comparing depreciation curves, service records, and real-world mileage instead of trading stories about lineage or legacy. The badge still mattered, but it no longer commanded the authority it once held. That pressure grew most visible in the boardrooms, where numbers, not emotions, decided the next move. If you value clear analysis without corporate spin, make sure you subscribe before you leave. Every upcoming report covers the shifts manufacturers rarely address, and staying subscribed ensures you get the truth first, long before the official statements try to redefine it. Investor panic and corporate tightening. When the early warning signs reached corporate offices, the tone of board meetings shifted quickly. Companies that had spent years projecting steady growth began softening their guidance, choosing cautious language over confident forecasts. Investor calls, once filled with forward momentum, now carried a strained undercurrent as executives tried to explain swelling inventories, weaker demand, and internal stress without triggering panic. But investors can read between the lines, and many did. The concern spread almost as fast as the oversupply. Credit markets reacted next. Lenders, who once extended generous floor plan terms to dealers, tightened their windows sharply. A 6-month grace period shrank to 90 days, sometimes less. Interest rates nudged upward, and review cycles grew more aggressive. Dealers who had relied on predictable credit suddenly faced a landscape where every extension required justification and every slip raised eyebrows. This tightening made it harder to breathe, let alone stay ahead of inventory costs. Factories responded with austerity. Research and development budgets were scaled back, delaying or downsizing projects that had once been marketed as the future of riding. Marketing departments trimmed campaigns, canceled events, and shifted to digital strategies that cost far less than physical showcases. None of these moves were advertised publicly, but insiders saw the pattern forming. When a company braces itself, the cutbacks ripple through every hallway, from design studios to purchasing departments. What happened next unfolded on the factory floors and in the small towns that depend on them. Labor, fallout, and community shockwaves. The slowdown that began with data and boardroom decisions eventually reached the factory floor. Workers who had counted on overtime for years saw those hours disappear almost overnight. Second shifts were trimmed, weekend crews were canceled, and regular schedules were shortened to conserve costs. Lines that once hummed with constant motion slowed to a careful crawl. Employees felt the change immediately. Paychecks shrank, and with them, the sense of stability that had carried many families through previous cycles. The cutbacks spread beyond the plants. Towns built around motorcycle manufacturing rely heavily on the wages that flow from those facilities. When hours dropped, diners lost their morning rush. Hardware stores saw fewer weekend customers, and small bars found their Friday nights quieter. Each paycheck, reduced by a few hours, meant fewer dollars circulating through the community. Local business owners began sharing their worries with familiar faces at the counter, wondering how long the downturn would last. Families felt the strain most quietly. Plans for home repairs were postponed, vacations canceled, and savings accounts stretched thinner with each passing month. Workers with decades of experience carried the weight heavily, not only concerned about their own futures, but about what the downturn meant for a craft they had dedicated their lives to. Pride in their work remained, but uncertainty shadowed every shift. The next phase rested heavily on rider behavior within the shifting market. The spreadsheet revolt. Riders take back control. As the market struggled to steady itself, riders began doing something the industry had not expected. They stopped trusting the sales pitch and started trusting the numbers. It began quietly with a handful of buyers decoding VINs to track build dates, factory options, and origin codes. Soon that careful approach spread. Riders compared multi-state quotes, checked auction histories, and cross-referenced listings from coast to coast. A new kind of buyer emerged, one who walked into a dealership armed not with a dream, but with spreadsheets. This shift marked the rise of a transparent pricing movement. Riders shared data in forums, created comparison charts, and posted screenshots of listing trends that cut through the fog of marketing. Sellers who once relied on emotional pull now found themselves facing customers customers who already knew the true floor of every model, every year, and every trim. The power balance tilted, knowledge flowed in one direction, and it was no longer from the sales desk outward. Riders reclaimed the upper hand with facts instead of hope. For the first time in a long time, people who loved motorcycles felt they could navigate the market on their own terms. That confidence began reshaping habits, guiding purchases, and setting expectations that dealerships could not ignore. The more riders learned, the more the industry felt the need to adapt. Behind closed doors, factories prepared their own response to the new reality riders were creating. Factory countermoves, strategy behind the curtain. Manufacturers understood the shift long before most riders realized how deeply the market had changed. Their response unfolded with quiet calculation, not public announcements. The first change appeared in the form of slimmed-down catalogs. Instead of sprawling lineups stuffed with overlapping models, factories trimmed the excess. Redundant trims disappeared, niche variants faded out, and the year's offerings leaned heavily toward proven platforms with predictable volumes. It was a strategic retreat designed to conserve resources without signaling panic. Pricing adjustments came next. Instead of bold promotions or loud markdowns, factories restructured MSRPs with careful subtlety. A model might reappear with a slight recalibration in its base price, or certain options might shift into bundled packages that altered perceived value while protecting margins. These moves were small enough to avoid scrutiny, but significant enough to influence dealer behavior. The industry recalibrated quietly, using the price sheet as a steering wheel. Region-based allocation emerged as factories stopped shipping motorcycles everywhere at once. They studied demand, dealer histories, and demographics, sending touring models to strong regions and limiting mid-weights elsewhere, placing each unit where it stood the best chance of moving quickly. Government voices stepped into the industry narrative forcefully. Politics grabbing the crisis, the new talking point. Once the flood of motorcycles turned into a nationwide conversation, political voices saw an opportunity. Suddenly, affordability became a talking point on campaign stages. Candidates spoke about the cost of transportation, using motorcycle prices as an example of broader economic pressure. What had begun as an industry-specific issue grew into a symbol of household strain, and that shift brought new attention, not all of it accurate. Tariff debates intensified as lawmakers questioned duties on imported models, creating confusion when identical motorcycles faced different costs based solely on origin. Politicians seized the moment, using the chaos to push trade agendas. Manufacturing anger followed, with candidates touring shuttered plants and struggling towns, turning the industry's hardship into fuel for promises of protection, investment, and renewed American production. As the dust settled, a cultural reset began taking shape among people who refused to let the spirit of riding fade. Culture reset, returning to tools, not toys. After months of uncertainty, riders across the country began rethinking what mattered. The days of buying a motorcycle for its badge alone started to fade. A new pride emerged around machines that could endure long distances, handle real-world wear, and keep moving year after year without compromise. Reliability became the new currency. Riders talked less about prestige and more about proven engines, simple maintenance, and build quality that stood the test of time. Long-haul comfort returned as the gold standard, pushing riders away from flashy styling and back toward honest seating, solid wind protection, and real mileage comfort. Road trips regained meaning, and the culture shifted toward purpose over presentation. This reset revived simple, durable machines. Carbureted models and older sport tourers earned new respect, proving resilience matters. Riders embraced tools they could service themselves, stepping into a new era, grounded in authentic riding values. Once the headlines fade, the real lesson comes into focus. This change was not just about products moving on or off the market. It showed how fragile assumptions can be when conditions shift fast. The advantage belongs to those who stay observant and adjust early, rather than chasing narratives. If you have experienced this shift yourself, leave a comment with what stood out to you. And if thoughtful context like this is useful, like the video and subscribe so you do not miss what comes next.